Starbucks, Amazon, Apple, Netflix, Tesla, and Circle. 6 of the most popular stocks in the market today. 6 stocks that are probably in many of your portfolios right now. Some old and some new. But what if you had to find the best stock to trade to fit a $30,000 account today? How would you do that? Well, I'm Dr. Jim, and after having traded for nearly 20 years now and having been on the Tasty Network for the last 10, we've created a 5-step checklist that's going to help us walk through exactly how to find your next trade. As we work through each step on the checklist, we're going to use market metrics, strategic choices to help us narrow down the list. And one by one, we're going to eliminate a ticker from the list until we're left with one ticker, one strategy, and we execute the trade. So let's get started with step number 1, liquidity. So the first step in finding a new trade and a new trade's journey is without question liquidity. You need to make sure that you are trading a very, very liquid stock, because I can say from personal experience, there is nothing worse than getting exactly what you wanted. You get the move that you want, the perfect position is on, the strategy checks out, and then the next thing you know, you can't get out. You can't get out for a good price because you're trapped in a very, very low liquidity stock. You're stuck. So in this situation where the liquidity in the stock is really, really poor, you essentially have 2 choices. You either A, stay in the position a bit longer and wait for the price that you've been targeting all along, or B, you get out at a worse price essentially and take a fill on a price that isn't necessarily near the mid price or the mark price at that time. Neither one of these options is good for you. So to avoid essentially any and all problems associated with liquidity, you want to do 2 things, both of which are pretty simple. Number 1, check the liquidity star ranking in the tastytrade platform. And then number 2, cross-reference that with the bid-ask spread differential that's in the market at that time. Doing these 2 things will keep you on the right side of liquidity pretty much every single time. So let's dive in. All right, so we already have our list of 6 stocks, so we're going to work mostly from that list. But if you didn't have a list already, just go into tastytrade, click on the watch lists. You can use Tom's watch list, or you can use the Tasty default watch list as a great starting point. Okay, but with our stocks, I want to begin by checking the liquidity star ranking for each one. So here's Starbucks. Let's go over to the overview tab, and then you can see the liquidity star ranking, 4 stars. So Starbucks looks good. Here's Apple. We go to the overview again right here. You can see also 4 stars in the liquidity ranking. So Apple is good. Tesla, overview, liquidity ranking, also 4 stars. So Tesla is good. Netflix, overview, liquidity ranking, only 2 stars. Okay, so a big question mark by Netflix. Amazon, overview, liquidity ranking, 4 stars. So Amazon is good. And lastly, Circle, overview, liquidity, only 3 stars. So it appears it's going to be between Circle and Netflix for which one gets the chopping block. Now, again, to cross-reference the liquidity, now we're going to turn to the bid-ask spread differentials. So with Circle still loaded up, let's open up the October cycle with 44 days to go, because that's closest to that 45 marker where we like to enter our positions. And let's just simply look at the at-the-money strike. You've got Circle at 120. Let's look at the 120 strike. You can see that the bid-ask spread differentials are about 60 to 70 cents. I mean, they're moving around as the market moves, but about 60 to 70 cents on the put side and also on the call side. Now, generally speaking, for the most liquid names in the world, like SPY, like QQQ, you're going to see 1 penny wide markets. You're going to see 3 penny wide markets. You're going to see really, really tight bid-ask spread differentials. Now, with a lower liquidity name, we might be willing to accept slightly wider markets, but Circle at 60 to 65 cents for a $100 stock, I would much prefer to see that at maybe 10 cents or 15 cents. But let's now take a look at Netflix. If we look at Netflix with 44 days to go, same thing, right? But this is a $1,200 stock. So if I look at the bid-ask spread differential for the at-the-money strike, look at what we see. We see at the 12.15 strike, you can see that you're only about $1 wide on the put side. You're a lot wider on the call side, $2 wide. But you have to keep in mind, this is a $1,200 stock. So on a relative basis, I would argue that Circle is a lot less liquid than Netflix because the bid-ask spread differentials are going to scale with the stock price. So Circle is gone off the list. The liquidity is just not good enough. The next market metric that we want to turn to is volatility. At Tasty, we feel the most opportunity as an active trader is with a focus on volatility. It's not directional. It's not trying to get bullish for the next leg higher or get bearish for the next leg lower. It's actually trading volatility and specifically elevated volatility and trying to sell that volatility to take advantage of its natural tendency to contract over time. Now, we already have an entire crash course dedicated to volatility, so definitely check that out when you have a chance. But simply put, our foundation is short premium, so selling options. By selling options, we're able to essentially put probabilities in our favor, put the passage of time in our favor, and then also position ourselves to take advantage of any volatility contraction over time. So we really like the short side of the option contract when it comes to the strategic choices that we make. But we don't want to just sell volatility willy-nilly. We want to be strategic and we want to be patient. So that is why we prefer to sell volatility when it is indeed elevated. Volatility is a unique characteristic in that it has been shown to demonstrate a mean reverting property. This is something that can be shown both empirically and also mathematically. Now, of course, you never know exactly when volatility is going to contract. It's never going to be that easy. But by selling elevated volatility, we are stacking the probabilities in our favor to eventually ride the volatility contraction later on down the road. Okay, so let's take our 5 remaining stocks, take a look at volatility, and see if we can't narrow down the list even more. So to begin looking at volatility, it's always kind of best practice just to get a gauge of where is market-wide volatility. And the best ways to do that are to look at the VIX or the /VX futures. So if I scroll down here on the Tasty default watch list and it's in alphabetical order, you can see the VIX right now is at almost 17. That's right around the historical average, maybe slightly over a historical average of around 16. Similarly, volatility futures are right around 17 or just over 17. So this tells me that volatility is around historical average, maybe slightly elevated in an overall market sense. But really, I'm not interested in market-wide volatility. I want to get laser focused with individual stock volatility. So similar to what we did with liquidity, let's just go through our stocks one by one, starting with Netflix. And the metric I want to look at is the IV rank. An IV rank shows me where volatility ranks on a percentile basis relative to where it's been over the last 12 months. So obviously a 9.6, like what I see here in Netflix, is telling me that it is essentially on the lower end of the distribution of all volatilities for Netflix for the last 12 months. So Netflix, 9.6. Okay, Starbucks, 20.6. So much better candidate for selling volatility because remember, I want to sell elevated volatility. So Starbucks certainly looks better than Netflix. Apple, IV rank of 14. So also looking relatively okay, at least in relation to what we saw with Netflix. And then Tesla also at 9.6. So very similar to what we saw there with Netflix. And then lastly, Amazon, only 6.2. So of the 5 remaining stocks, Amazon clearly has the lowest IV rank. So it essentially presents us with the least amount of opportunity as premium sellers. So Amazon is gone. Our list is indeed narrowing, and the time has come to finally choose direction here in step number 3. Are we going to play the stock higher? Are we going to play the stock lower? I mean, in my estimation, this is the age-old question. This is what everybody wants to know. And in my humble professional opinion, nobody knows where any stock or any market is going next. The markets are far too random and unpredictable. And so when it comes to picking direction, that honestly takes a lot of pressure off. I mean, by all means, use the technicals, use the fundamentals, use volume profiles, use order flow. Hey, you could even use your portfolio metrics to guide you. Quick little shout out to another crash course that is already on the YouTube channel all about portfolio management. But perhaps an even simpler method, and one that we generally deploy here at Tasty, is to kind of adopt a short-term contrarian mindset. So when something is down, we like to buy it, and when something is up, we like to sell it. All right, so let's take a look at Starbucks, Apple, Netflix, and Tesla and see if anything jumps out at us. All right, so for the 4 remaining stocks, Apple, Netflix, Tesla, and Starbucks, let's just bring up a daily chart, and we're not even going to measure any technical levels or moving averages or support resistance or any of that. I mean, you could do all that if you want to, but just very simply, I want to get a feel for, is something jumping off the page from a short-term contrarian standpoint? So Apple, to me, looks like a pretty obvious short. Now, I say obvious jokingly because nobody knows what's going to happen next, of course. The randomness and the unpredictability will indeed take over. But if I had to choose a direction in Apple, it would be bearish. Okay, now Starbucks, conversely, this is a different story. To me, this looks like a bullish opportunity. Not to mention today, Starbucks is even down a couple of dollars. So for Apple, I'd probably want to get bearish. For Starbucks, I'd probably want to get bullish. If we bring up Tesla, this one looks a lot less clear, right? From a short-term contrarian standpoint, I think you could make the case that you could go either way in Tesla, bullish or bearish. And then with Netflix, very similar story to what we just saw in Tesla. I think it's hard to make a case either way. You could probably make a case for being bullish here. You could make a case for being bearish here from a contrarian standpoint. So it seems like Tesla or Netflix is probably on the chopping block. So how are we going to determine which one of these we should get rid of? Well, now this is where we can go back to some of the previous steps on this checklist to see if there was a clear winner or loser with liquidity or with volatility. Now, interestingly, remember with Netflix, the IV rank was 9.6. With Tesla, the IV rank was 9.6. I mean, that's quite serendipitous. It is literally a tie. But what about liquidity? This is where it's going to tell a very different story, right? Tesla, remember, we go to the overview tab, liquidity, 4 stars. Very, very liquid. Netflix, if I click on Netflix, liquidity, not so liquid. So only 2 stars on the liquidity meter. So Netflix is gone and Tesla remains. Okay, so direction is always tricky, but for now, Netflix is gone. Let's put that guy on the shelf. That leaves us with Starbucks, Apple, and Tesla. And it is now time here in step number 4 to decide, are we going to do undefined risk or are we going to do defined risk? And the answer here is simple. Defined risk. If you're just starting out, every single one of your trades should be defined risk, 100%. Now, is undefined risk more effective than defined risk? Yes. Is undefined risk going to essentially give you more opportunities than defined risk? Yes, but you're just starting out. We are just getting going. You have to build up your experience and your exposure to the market before you ever consider an undefined risk strategy. Remember, this isn't a race. This isn't a competition. There is plenty of time to grow into the riskier strategies that may be more effective sometime down the road. For right now, let's get laser focused on defined risk only. All right, so Apple, Tesla, and Starbucks, that's what's left. So which direction are we going to play? Well, as you can see, it largely depends on which stock we're going to choose. So let's proceed with the checklist and we'll circle back to direction. And to really drive this point home that essentially this case could be made with any of the stocks that we have left, Tesla, Apple, Starbucks, it doesn't matter. Defined risk versus undefined risk. Let's compare and contrast like a short strangle versus an iron condor. Short strangle, undefined risk strategy, iron condor, defined risk strategy. So with Apple pulled up, let's sell a strangle together. So if I sell a 220 put and then I sell a 255 call, this is a classic short strangle. This is a great strategy, a very popular strategy. But when you click over to the curve view and you click on the analysis tab inside of the curve view, you get a nice visual representation of this strategy. And so it's essentially showing you that you have unlimited risk on both sides of the market. Just starting out, this is not something that we want to engage with. So back on the table view, let's buy some wings. Let's buy a 215 put and let's buy a 260 call. If you go back to the curve view, you can now see that your risk is indeed defined. Now, this is not the greatest trade because we're only collecting $1.20, but for illustrative purposes only, it does showcase the difference between defined risk and undefined risk. So with whatever stock we choose, we are definitely going to lean on defined risk because this is the best way to start as a new trader. Okay, but one of these stocks has to go. I mean, those are the rules. One step, one stock gets eliminated. Well, again, let's use the previous steps as a tiebreaker, right? Apple, IV rank 13.9. Starbucks IV rank 20.8. But Tesla IV rank still only 9.6. So we are going to eliminate Tesla, and that leaves us with only 2 remaining stocks. All right, so we've made it to the final 2. Tesla is gone. Tesla is forgotten. It's all about Starbucks or Apple. And so now it's time to select a strategy, pick one of these stocks, and execute the trade. And if you are just starting out, like a pretty brand new trader, the one strategy that I would focus exclusively on in the beginning is a pretty clear choice: the vertical spread. And more specifically, since you want to sell volatility, the short vertical spread. Now, with short vertical spreads, you are going to be directional. If you want to be bullish, you would choose a short put spread. If you want to be bearish, you would choose a short call spread. And remember, with Starbucks, we were leaning to the bullish side. And with Apple, we were leaning to the bearish side. So the strategy that we select is going to kind of go hand in hand with the stock that we end up choosing as well. And so to help us do all that and essentially complete the checklist, we are going to lean on some of the tasty methodology to choose our strategy, select our stock, and execute the trade. Okay, so we've got Starbucks and we've got Apple. If we're going to choose Starbucks, we're going to be bullish. If we're going to choose Apple, we're going to be bearish. So if we're going to choose Starbucks, we're going to choose a short put spread. If we're going to choose Apple, we're going to choose a short call spread. So one of the key rules with short vertical spreads inside of the tasty methodology is we want to make sure that we're collecting enough premium on entry. So with a vertical spread, we want to make sure that we are collecting at least 1/3 the width of the strikes. By doing this, the risk-return relationship is a little bit more balanced in exchange for a high probability trade. So if I go into Apple, October with 44 days to go, and you've got the stock at 237, let's say I just sell a 240, 245 call spread. If I do that, you can see the probability of profit looks good. The credit collected looks really good. I'm collecting 227, so well over 1/3 the width of the strikes. So Apple looks like a pretty good candidate right here and right now. Okay, so let's do the same thing with Starbucks. Starbucks, 44 days to go, October cycle. Let's go just one strike out of the money. Let's sell an 85 put and buy an 80 put for the 85-80 short put spread. Look at the credit collected. It's only $1.33. So it is actually much less than 1/3 the width of the strikes, even with Starbucks having a higher implied volatility rank. So it appears that the winner is indeed Apple. So with Apple at 237, our short call spread is selling for about 230. Let's see if we can get filled. And there you go. We are now bearish on Apple with a short call spread, having worked through the 5-step checklist that we just worked through. And so I hope this helped, and we'll see you guys next time.